Greetings, everyone. Today is Wednesday, August 13th. This is the midday update for the daily scan, and it is almost noon on the East Coast. So we'll take a look at what the market's doing today after the CPI report yesterday. As always, I am not a financial advisor, so this is for educational purposes only. Let's take a look at the charts and see what today has in store for us. For the subscribers on the charts page, on the left-hand side, right down here are the 10-minute charts. So we'll take a look and see what's going on today. Got a little bit of a pullback, got a gap up in the morning, pulling back right now, but still above the open. But it looks like it might be starting a pullback as we head into options expiration Friday. And then, of course, the end of August and into September is the weakest time of the year. So maybe that big rally could have been it for now. But I do believe by the end of the year, we could be hitting 7,000 on the S&P. Market needs a pullback anyway. It would be healthy for it to pull back a little bit and just take a break. You can see down here, technology is doing okay, going a little bit down. Financials up a little, discretionary up, communications up, industrials down, but overall the aggressive sectors are still hanging in there. So they're the ones carrying the market, which is good. Money flow, you notice money flow is coming down right now as well. So it's below the 45 line, which is my line of demarcation, where it starts to go negative. All right, the defensive area, healthcare is up, staples are down, energy down, utilities, call it flat, materials up. So not telling us much there. Everything's pretty much flat. So I think the aggressives are still hanging in there, but the market is just sort of taking a break right now today. And you can see we got a red bar right now. These are the rotation areas. Growth versus value is heading down. Discretionary versus staples looks pretty good, actually. Technology is down slightly. Semis down slightly. Internet down quite a bit more. So remember, this is a 10-minute chart. So what you want to do is look at the overall trend across these whole 7 days. Not necessarily that it's just down here in the morning. It's actually lower than it has been, and it's below the zero line. So that really is the key. So these horizontal lines right here, that's what you need to focus on. So internet stocks right now are heading lower. Look at the Russell. The Russell actually has been the stronger one today, which you should expect with potentially rate cuts coming. That the IWM Russell 2000 is the area that's going to benefit from that, as well as home builders, transportation, healthcare to a degree. Those are all the area. Banks are going to benefit. So those are all the areas, and a lot of the Russell 2000 is made up of those kind of stocks. So that one actually is doing better than the S&P today. And you can see money flow is staying up there. So money still is flowing over into the Russell 2000. But where is it flowing? This is the growth versus values. So large cap growth versus value, mid cap, small cap, they're all heading down, which implies that the rotation is not necessarily to the growth areas of the Russell 2000, but instead to the value areas. So what that means is traders are looking for the stocks that have sold off a lot, which is what creates value when they sell off quite a bit. So looks like they're moving into those ones that have big sell-offs, anticipating that lower rates are going to push everything higher in the Russell 2000. I think that's what this is telling us right here. So we'll keep an eye on that, see what happens. And then the trend, this is a counterintuitive chart. So when it's going up, that means it is negative for the market. It essentially is a relationship between the advancers and decliners and the volume, the up and down volume of advancers and decliners. Notice it just ticked down a little bit. So if it's up, that's why this is red. When it's going up, it's actually negative. That means the market is coming down. If this continues to move lower and actually goes down below this red line back to the one area, then that is implying that the market will reverse and start to move higher again. But if it stays up here above one, then the market may continue to go down. We'll have to watch it. Notice the up volume minus the down volume yesterday was huge move. Much higher up volume with advancers than there was down volume with decliners. But today it's the opposite. it's come all the way back down again. So keep an eye on that. Right now, it's implying that the market may want to pull back and take a break, which actually would be a healthy thing for that to happen. All right, the dashboard, Bitcoin is doing great, 121 right now. Ethereum is actually doing even better. Ethereum has been really on a tear. Equities, you see the S&P 500, everything is up, but just slightly. The VIX actually is down a little bit still, even more, down to 14.6. It's not the lowest that it's been, believe it or not. It's actually been down around 10 or 11 was the lowest that it's been. So it could potentially even go lower than that, but that is very complacent for the market. The 10-year yield is moving lower, so that's good for stocks and commodities. Gold moving a little bit higher. Oil continuing to drop, going lower. So oil really is the one that brought in that tame CPI or inflation number. It was really oil and gas were the two. Gas is moving up a little bit, but that's really what brought in that lower number. Commodities in general are heading down as well. So on the sector side, the discretionary is the one aggressive sector in the top three. Healthcare and materials are both somewhat defensive. The bottom, staples, utilities, are defensive areas, along with real estate, and industrials a lot of times is aggressive. So it's a mixture, and the advancers and decliners are green right now. Best Buy reported today. Looks like they missed. Let's see what Best Buy stocks looks like. Yeah, they look pretty good, actually. It's moving up. So that's what the dashboard looks like. These are the top 10 over here. Dave had a big sell-off. It's making a comeback today. Life 360 has just been screaming higher. So that one's looking really good. We got two down. Solar Edge starting to come back up. AMD moving higher again. So all of those look great. On the bottom, Interactive Brokers is on the bottom. Robinhood down on the bottom. GE, big red candle for GE. GEV, GE Vernova, big sell-off today on that one. We'll see if the rest of the market keeps going down, if these are going to go down with it. So keep an eye on that. All right, one thing I want to show you on my alerts is I did get another short squeeze alert. Here's what my alerts look like from stock charts. So CRNC had a short squeeze alert today. You can see right there. Looks really good, heading higher. That definitely is a short squeeze. So all of these shorts are starting to cover right now. So it's above all of its previous resistance levels. That's what causes shorts to feel the pain, is when the level that they bought at gets taken out. So look at right about there. So all the shorts were entering in back in here, and now that it's above that level, they're starting to cover. So you've got longs that believe in the company, it's a software company, and you've got shorts that need to cover, and both of those have to buy in order to do that. So that's what's causing that short squeeze to happen. Short squeeze stocks, by the way, for subscribers are on the chart lists and scans page. Every week these get updated, and they change every week, because just like that one, that might not be on next week because the shorts are now covering. So there won't be as much of a short situation. There's 63 symbols this week, and this is a CSV file that you can download into your own platform if you want to. All right, let me use this chart and look at one that somebody asked me about, which is SOX-S. This is the semiconductor inverse ETF for semiconductors. It's very, very low. Absolutely, extremely low right there. And for subscribers, if you go to the charts page, all the way at the bottom in the blue column, down here are a bunch of short ETFs, and it will show you the short and the long side by side. So here's SOX-S. That's a 3X short for the semiconductors. And we'll put it next to the long SOXL for semiconductors. And you can see right here, I mean, you can kind of tell this is a relationship chart, a relative chart between the long and the short. So when this crosses to the upside, this is the time to get out of the short and into the long. And that also happened right here as well. So this would be the time to get out of the short and into the long. This would be the time to get out of the long and into the short. But right now, yes, SOXS is going much lower. Don't know if that's going to reverse. We've got NVIDIA coming up week after next, I think. Usually runs up into earnings, and that will probably drive this higher as well. So we might get a brief pullback into Friday and maybe into next week. The market needs it. It would be healthy if the market did that. But semiconductors are going to really be driven by NVIDIA, and NVIDIA probably is going to report good numbers week after next. Let me see exactly when the date is for NVIDIA. It is the 27th. So August 27th, today's the 13th, so exactly 2 weeks from today. And you can see NVIDIA starting to move down a little bit, but well above its 21 still. If anybody's looking to get in, of course, never know what's going to happen with earnings, but I suspect they will have good earnings. Then it's a matter of what the reaction is. Will it be sell the news, buy the rumor, sell the news? Don't know. Right now it's at 180 and the 21 is at 175. So if you put an order in down here at 175, just like this, if it pulls back to that, takes it and then heads higher. That's something that I suggested for somebody to do on AMD. Put an order in at the 21 down here. It came down at 160. I said 160. Came down and took it out, and now it's at 183, about a week later. So it's up about almost $25 in 1 week. So that's the way to get into these stocks that just continually run up like this. You can notice that they often will come back to the 21 and then continue to move higher. So if you want to get in, just be patient. Patience is one of the hardest things to do in trading. Just put your order in down here and it'll come down and take your order, and then you can ride it up along with the with everything else. All right, the last question is a really good question that I want to spend a little bit of time on, and that is, can I rank the order of my favorite indicators? So what they asked was, or the example they gave was, if you're looking at, let me use this chart right here. So I'm using IBM in this case. If you're using money flow, which ones do you like the best? Do you like the Chaikin money flow? Do you like the MFI? But what is the order of preference for me of the indicators? So what I'm going to do is I'm going to remove the indicators in reverse order. And we'll watch the chart and see how it looks as we do that. So the first one I would remove in this particular case is the cloud indicator. That's a nice one, nice reference point to see whether it's neutral or it's in an uptrend or a downtrend, above or below the cloud. But there are other ways that you can tell that. So if I were to remove the cloud in this case, there's what the chart would look like right there. You've got, these are the money flow indicators down here, and I have the MACD up here. So what would I remove next? The next thing I would do is remove the Chaikin money flow. That's this one right here. So remove that one. That leaves me with the RSI and the MFI, the money flow index. So as I explained yesterday in Technical Tuesday, the money flow index is essentially an RSI with volume, which I actually really like. So I can kind of get the same sense as the RSI, but I get the added benefit of having volume using that one. So the next one I would probably remove is the RSI in this case. So I'll take that one out. And now I'm just left with MFI. And I'll make this a little taller so it stands out more. Oops, did I do that right? Yeah, height I want to be 1. Oh, I want this to be below. Height of 1, there we go. We'll make it 5. All right, so there's the MFI, money flow index. So now I have basically at the top is the MACD. By the way, this is when I get down to the final look and feel, it's essentially what you can do with the free version of stock charts. So you can essentially use what you get for free with stock charts. It's not going to give you all the nuances of all the other indicators, but you can certainly do that. All right, so what would I remove next? What would be my next least needed indicator? Well, I think in this case, by the way, notice as the price goes up on IBM, the money flow has gone down. So that is a bearish divergence. That would have given you early warning that this was going to roll over. And then the MACD up here confirmed it right there. So the next one I would remove is that money flow indicator. So I'll take that one out. Now I'm left with basically the price, some moving average lines, and the MACD at the top. So the MACD, this black line, if it's below 0, it tells you that it confirms a downtrend. If it's above 0, it confirms an uptrend. That's why I say you can identify the same thing that the cloud gave you a visual representation of, but you can do the same thing with the MACD. I use a PPO, but MACD is the same thing. PPO just uses a percentage, whereas the MACD uses an absolute number. That's the only difference. They're basically exactly the same indicators. So if the black line is below 0, it's in a downtrend. If it goes above 0, it's in an uptrend. Now, what would I remove here? Well, the next thing I would probably take out is the 13-day exponential moving average. That is just a reference point. That is this orange dashed line right there. It's very light. I like to see when the 5 crosses the 13. That tells me there's a change of character in the chart when that happens. You know, it happened to the upside way back here, happened to the downside way up here. So it can give you an early signal, has not gone back above it yet. But that would be the next one I would take out, is that 13 moving average. So now I'm left with this. Now I have a 5, a 21, a 50, and a 200, and the MACD, and of course volume at the bottom. So the next one I would remove is the 5. Take that out because the 21 can give me similar signals if I just watch where the price moves above the 21, where it closes above the 21. Right there would be an entry to get in, and right here would be a signal to get out. Right there or right there, either one of those signals would be signals to get out if it closes below the 21. So that would be the next one that I would take out. Now the next one is a little bit more difficult. So it's going to be a choice between a moving average line and the MACD. And I think what I would do is take out the 50 and just leave in the 21 and the 200. So 200 is a really important one. Nothing good happens below the 200-day moving average. So I also always want to be in stocks that are above their 200-day or about to cross over the 200. And the 21, of course, on more of a short-term basis is an important one to watch as well. So that's what I would get down to there. Now I still have the MACD, so I can see the crossover right there. In addition to closing below the 21, you can see the MACD has already crossed over. The histogram has already gone below 0. So all of these are confirming each other. But the next one I would take out is that MACD. I use a PPO because it uses percentages. That's the only difference. Same thing. Take out the MACD. By the way, you could have 3 moving average lines and a MACD with the free version of stock charts. So you don't need to sign up for a subscription if you don't want to. There's a lot of benefits to having a subscription, but you could potentially get this and the MACD without a subscription. So that's what I would look at next. I would take out the MACD and just leave it like that. And then finally, the last one I would take out would be the 200-day moving average. Remove that. And now I'm just left with the 21. So this gives me a sense for what the medium-term direction or trend of the stock looks like. And then finally, the last one I would take out is that 21-day exponential moving average and be left with just price and volume. And that is basically all you really need is price and volume. So price and volume will tell you everything you need to know about what the trend of the stock is doing. And I put in a moving average line down here on volume so I can see when there is more than average or less than average volume. So you can see as this trend up here was moving up, the volume was very low. And then it got up here and went sideways. So that would be the last one right there. I probably would like to leave volume in, but I could even remove volume and just have nothing but price. And at the end of the day, price is king. Price is what tells you, that is the culmination of all of the knowledge in the market from all of the hedge funds, the investment houses, individual traders, everybody that's in the market is reflected in the price, including the fundamentals of the company is all included in the price. So at the end of the day, price is the most important thing to watch for. And then what I might do with just price is switch this over to the impulse system. So I can now, just in a visual like this, get a sense for both trend and momentum just by the colors of the bars. So green means trend and momentum is up. Red means trend and momentum is down. Blue just means neutral, means one of those two is different than the other one. I did a whole session on the impulse system back on a Technical Tuesday if you want to go back and review that. But at the end of the day, you could get by with just this, because this shows you, clearly the trend is all green right here. You could actually watch as the stock comes down, and a character change is a higher low, or higher low right there, and then just wait for a green bar. Get in on the green bar. You don't need moving average lines. You don't need a MACD. You don't need any of that. Just get in on the green bar and then ride it up, and get out on the red bar when it comes down. All right, so that's what I would do. That's just a very quick overview of how I would rank the indicators that I use, and it's pretty much how I look at them as well, the order that I look at them in. As I've always said, never use just one indicator. Always use multiple indicators, but that's what I would do. And that right there is the final view that I would have. All right, thanks everyone for watching. Hope everyone's doing well. Let's go take a look real quick at what the market looks like right now. The Russell 2000 is doing great, continues to go higher, while the S&P is just kind of going sideways at the low. So clearly the Russell is the big winner today. That's the one that's going up the most. Let's see, here's the defensive sectors. Not too much change. And the aggressive sectors, technology looks like it's still coming down. Technology makes up like 34% of the S&P. So that is the main one that drives everything usually. So if this one continues to fall, then the market may be heading toward a brief rest. It needs to take a rest anyway, but that's what it looks like right now. All right, thanks for watching. Please let me know if you have any questions, comments, or anything you want me to look at. Be happy to do it. And be careful. Talk to you later. Take care.